Inclusive workspaces lead to better decision making, increased innovation, and improved financial performance. Companies that provide gender balance have produced better returns on equity, returns on total assets, price to earnings ratios, net internal rate of return, and valuations in public and private capital markets. One way to advance gender equality is through increased transparency and accountability. ESG disclosures provide a platform for companies to report on their gender diversity initiatives, policies, and progress. By making this information publicly available, companies can be held accountable for their actions, and investors can make informed decisions based on company commitment to gender equality. ESG disclosures can also help identify workplace gender disparities. Globally, women hold only 20.4% of board seats, only 6.4% of board chair positions, only 5.1% of CEO positions, and only 15.7% of CFO positions. By analyzing this data, we can identify the areas where women are underrepresented and take targeted action. ESG disclosure also have the power to drive change beyond individual companies. By comparing gender diversity matrix across industries and sectors, investors can identify leaders in gender equality. That can influence investment decisions, encouraging capital to flow toward companies that prioritize gender equality and creating a powerful incentive for companies to improve. ESG disclosure can also help address the gender pay gap. By reporting on gender pay ratios and conducting regular pay equity audits, companies can identify and rectify any disparities in compensation. Investors are also encouraged to prioritize diversity in their own corporate structures. But to fully harness the potential of ESG disclosures in advancing gender equality, we need a comprehensive and standardized framework. A standardized framework would ensure companies report on the same set of metrics, allowing for meaningful comparisons and benchmarking. To achieve this, collaboration between governments, regulators, investors, and companies is crucial. Governments can play a role by mandating ESG disclosures and establishing reporting standards. Regulators can enforce these standards and ensure compliance. Investors can demand transparency and use their influence to drive change. And companies can embrace ESG disclosure as an opportunity to showcase their commitment to gender equality. As we know, stock exchanges can play a catalytic role in promoting gender equality. They are uniquely positioned to influence their home markets in a way few other actors can. They help connect companies, investors, and policymakers to support sustainable development initiatives, and they can play a crucial role in rallying the private sector to increase women participation in business and economic development. So what are we at IFC doing to improve the ESG performance of local companies and support their gender diversity actions? Pakistan is currently the second largest portfolio country for IFC in the Middle East, Central Asia, and Turkey region. Our current committed investment exposure amounts to approximately $1.7 billion across 47 companies in both short-term and long-term investments. Gender is an integral cross-cutting priority of these investments,